Welcome to This Explainer. Let's jump right in, because today we're exploring the invisible engine of the business world. For the next few minutes, I want you to step back and adopt a purely executive, strategic mindset. Picture the flowing data lines of global networks, factories, and logistics, all feeding directly into the financial pulse of a company. What we're looking at is a fundamental shift in how we perceive operations. You see, it's not just about moving boxes anymore, it's about moving cash. Which brings us to a really vital question. In most organizations today, there's this persistent kind of ordinary world illusion. We look at the supply chain and we just see execution. We see disruptions, delays, price spikes, shortages, and we see teams reacting manually, constantly putting out fires. But we have to ask ourselves, is your supply chain actually engineering financial value, or are you just perpetually reacting to operational chaos? To answer that, we're bringing in the supply axis framework. Think of this as the ultimate bridge between the highly physical, reactive world of operations and the structured, logical systems of finance. This model is going to be our guide today. It's designed to pull us out of that chaotic execution mindset and elevate us into a harmonized system of true financial translation. Okay, let's dive into this operational illusion. Managing suppliers, tracking shipments, negotiating costs, handling disruptions. These are the core things supply chain professionals do every single day, right? But this flurry of activity actually masks a hidden truth. Your supply chain sits at the exact intersection of suppliers, production, R&D, logistics, customers, and finance. It is not just about operations, it's literally the very place where business value is either created or destroyed every single day. And this brings us to a massive language gap inside modern organizations. Just think about it for a second. If the sales department faces a disruption or loses market share, they get to justify it. They explain the market shifts, they tell a compelling story. But if the supply chain faces a sudden supplier price increase, there is no story. There is only the expectation of action. You're just expected to renegotiate, dual source, redesign, or somehow absorb the risk. Supply chain is completely expected to react, not to translate, and certainly not to defend its value. Because of that gap, organizations lose critical clarity. The supply chain produces thousands of daily decisions, but it speaks zero financial language. So you end up with intense operational actions on one side and a totally empty finance dashboard on the other, with a giant question mark sitting right in the middle. The harsh reality is, what cannot be translated into financial language simply cannot be prioritized correctly, and that leads to massive corporate misalignment. So the crucial point here is making the shift from purely operational thinking to financial decision modeling. The supply axis perspective changes the game by boiling every single supply chain action down to three key dimensions. First, the investment. That's your CapEx, your effort, the engineering time. Second, the cost impact. Are we looking at savings or are we looking at cost increases? And third, time. Exactly when is this value realized? We have to stop asking, what is this operational initiative, and start asking, what is the cash flow impact of this decision over time? Once we translate those actions into cash flows, we unlock four critical financial lenses. Our first lens is net present value, or NPV. NPV simply asks, what is this initiative worth to us today? It factors in our investment, our savings, and the time value of money. This is a primary indicator of value creation. If your NPV is positive, it means the company is literally becoming richer because of your decision. Our second lens is the internal rate of return, or IRR. Now, this is all about the efficiency of your capital. It answers the question, how hard is my money working? If your IRR is greater than your weighted average cost of capital, your WACC, you are generating value. But if your IRR dips lower than your WACC, that's a massive red flag. That is pure value destruction, no matter how amazing the operation looks on paper. Lens number 3 is the payback period. Very simply, how quickly do we recover our initial investment? In the world of supply chain, speed is a proxy for risk. A fast payback means lower risk. A slow payback means you have a much higher exposure to future disruptions. Honestly, even a highly profitable project can fail catastrophically if the payback period leaves you exposed for too long. And finally, our fourth lens, economic value added, or EVA. I actually want to pause for a second here, because this is the most brutal, ultimate question of true value creation. EVA asks, after all costs and all capital charges, are we actually creating value? This is the metric that cuts straight through the noise. It doesn't care about operational effort. It only cares about undeniable financial truth. All right, let's see how this builds out in reality. Say we have two proposed supply chain decisions. Initiative 1 is a supplier replacement. It touches $2 million in spend, promises $300,000 in yearly savings, requires a $200,000 investment, and yields a positive net cash flow of $100,000 a year. Initiative 2 is an engineering change. $4 million in spend, $350,000 in savings, a $450,000 investment, leaving a negative net cash flow of minus $100,000 a year. Now, on the surface, sitting in an operational meeting, both of these sound like totally reasonable, standard initiatives. So let's run them through our financial lenses, starting with a 3-year net present value at a 12% WAC. Project 1 yields an NPV of $520,000. Project 2 yields $390,000. Both numbers are positive. They both look great. Any operations leader would look at this and immediately assume both are fantastic operational choices to move forward with. Now, what's really interesting here is the internal rate of return. Project 1 sits at a massive 145%. Project 2 is at a very respectable 56%. Again, both are technically positive. Both are well above our 12% WACC, so the narrative so far is strongly telling us that we have 2 solid value-generating projects on our hands. We move on to the payback period. Project 1 pays back in 0.7 years. Project 2 pays back in 1.4 years. Yes, Project 1 recovers its investment twice as fast, which is excellent. But 1.4 years for a major engineering change? That still seems completely viable on the surface. If you stopped your analysis right here, you would almost certainly approve both projects. And this brilliantly illustrates the danger of stopping at surface-level metrics. Let's look at the EVA truth. When we apply economic value added, the whole picture just fractures. Project 1 shows a positive $76,000. That's true, green value creation. But Project 2? It plunges deep into the red. It is actively destroying $154,000 in capital. That's a massive narrative twist. This right here is the turning point in our strategic thinking. The most dangerous initiatives in your company are not the obvious failures. They're the ones that look exactly like Project 2. A project can look completely acceptable in NPV. It can have a positive IRR. It can look operationally brilliant. And it can still secretly destroy your capital value. What we call good projects operationally can be incredibly misleading financially. Which leads us to complete executive clarity. We now have a new, unshakable rule for the boardroom. A project is not approved just because it looks good on an operational dashboard. It is approved because it consistently creates value across all financial lenses. So the decision becomes crystal clear. Project 1 gets the stamp go. Project 2 gets the stamp no go. And you have to stick to that, even if rejecting that engineering change feels totally counterintuitive to your operations team. That is the ultimate transformation here. That's the competitive advantage the supply access model gives you. Supply chain is not about execution excellence alone. Every single supply chain action you take is 4 distinct things. It's a cash flow shift, it's a capital allocation decision, it's a risk transformation, and it's a value creation opportunity. If you can't translate a decision into these exact metrics, you are only managing activity. You are not managing supply chain finance. I want to leave you with this final, fundamental shift in perspective. Supply chain is not operational management. It is financial value engineering. The very next time an initiative crosses your desk, I want you to ask yourself, are we just managing the chaos, or are we engineering financial value?